Hi, I'm Christina Troutwine, VP of Content and Partnerships at Hotel Business. And right now I'm with Evan Hurd, and he's the Principal and Managing Director at Robert Douglas. Welcome.
Thank you. It's great to be here with you.
Okay, good. So it's mid-year 2024. What are investors thinking about right now in terms of evaluating deals and in terms of market and rates?
I think as we're in the market selling assets, I think the big thing we're seeing right now is investors are very selective. I think for the last 2 years, people have spent a lot of time underwriting deals that just haven't happened. And so as assets come to the market now, I think we're getting a lot of questions about, seller motivations. But really, investors have done, people are frustrated, right? There's this wall of capital wants to get put to work. So I think as we're going to market with deals, there's kind of, the haves and the have-nots. And I think investors are pretty quickly figuring out where they want to put their money and where they want to spend their time.
So you mentioned sellers' motivation. So let's delve into that a little bit.
Sure.
Are they looking to sell right now? What are some of the factors that are leading to their decisions?
So seller motivations and what's catalyzing transactions, I think from our perspective, there are definitely situations where investors bought a hotel right kind of pre-COVID. Those markets have improved substantially. And even in, a difficult capital markets environment that we're absolutely in right now, those groups can book a win and look really good to their investors. The other, kind of forces that we're seeing push transactions, and I think this will show up more, and potentially ease some of the investor frustration and create more sales. There's a lot of loan maturities that are coming due.
Okay.
That's, billions of hotel loans that are maturing, I think $5-6 billion in 24, 25. And so as those come due and, mature, I think that's also going to create a lot of potential sales, potential recapitalizations. And then the last thing I would say, and this might, kind of dovetail with the maturities, these hotels need capital.
Right.
During COVID, we saw the brands, increase their flexibility with owners, just like we saw from lenders. But that, that lenience is starting to run out, if you will. And so there's a lot of hotels that have deferred maintenance that need a PIP, need some capital investment. And in some cases, the owners, don't have the ability or the desire to do that. And so that's also, let's say, catalyzing transactions from our perspective.
Okay. So then, Evan, would you say it's time to transact? How has the market changed for investment sales in the first half of this year?
Yeah.
Is it what you expected?
Yeah, we talk a lot about that, thinking about the fourth quarter of last year and some of the positive signs we got from the Fed with regard to rate cuts. Well, fast forward to now,
right,
hasn't really materialized. And so I think a lot of the activity that we were working on earlier in the year was kind of driven on the potential upside that we saw coming from, those rate cuts. And that kind of daylight in the capital markets. As that probability has gone down, and we still may see some, we're not going to see the 5 or 6 that were talked about last year. I think the market has changed a lot. And I think, equity has become a bit more conservative. That working in conjunction with some of these maturities, with some of these CapEx requirements that have to occur, we kind of see that enhancing the transaction market, and at least that'll spur more sales.
What about debt activity?
So we do advise raise a lot of debt in addition to investment sales. I would say different than the investment sale market, which is kind of a haves or have-nots like we talked about earlier. On the debt side, that's actually more of a sliding scale. So we're seeing lenders kind of pick their spots along that risk spectrum. So we're seeing a lot of liquidity in the debt markets. We're seeing banks very active. That's a big change from about 12 months ago. These are national or international banks. They're getting back into the market in a big way. They're probably the most efficient priced capital. So what that's doing is that's causing other groups to get more competitive. And the banks are kind of getting the best stuff. And so you're kind of seeing that spectrum, if you will, start to fill in nicely. If the banks are kind of the lowest price, lowest risk kind of capital, there's other lender types that are kind of filling in. At the other end of the scale will be construction financing, which is starting to tick back a little bit. That's still a ways off, but we are seeing a fair amount of liquidity in the debt space.
As we look to the second half of this year, how would you advise owners?
Yeah, I think a lot of the things that we're working on, it's taking a lot of time. and sometimes it's, one or two shots at a transaction. You're going to, a backup buyer or backup lender. I think, when those decisions are being made, when you've got a kind of a hard stop driving it, maturity date or some sort of another event, the end of a fund life, what have you, our advice is always just to kind of get working on it earlier, because it is taking longer now. And so we always like to say, just, if these things are coming down the pike, even if it's a hard potentially decision, to get working on sooner rather than later, just to give yourself the most options.
Yeah, definitely. Thank you so much for your time, Evan.
Pleasure. Thank you for having me.